What happened in the last 5 days just changed everything. Imagine waking up to news of a full-blown US-Iran war, missiles flying, oil prices skyrocketing, aircraft carriers moving into position, and your gold and silver investments flipping upside down overnight. That is not a hypothetical scenario. That is exactly what happened. Gold surged to a record high of $5,119 per ounce. Then it crashed back. Silver hit 97.30. Then it plunged 19% in a single session. 19% gone in hours. If you are holding precious metals right now, if you are thinking about buying, the next few weeks could make or break your entire portfolio. Here is the number that should stop you in your tracks. Global markets shed $2 to $3 trillion in the first 48 hours alone. Precious metals have been on a roller coaster that most investors have never seen before. And here is what they are not telling you on mainstream financial news. This war is far from over. The Strait of Hormuz is disrupted. 20% of the world's oil flows through that choke point, and the war premium is still building. If you own gold or silver, you need to watch this entire video. If you are thinking about buying, you need to understand why this moment could define the next decade of precious metals investing. Something massive just happened, and by the end of this video, you will understand exactly what it means for your wealth. Welcome to AG Profit Hub. This is where we cut through the noise and expose what is really happening in precious metals markets, while everyone else feeds you the official narrative. Subscribe right now and hit that notification bell, because this situation is evolving by the hour. We are growing fast, and for good reason. We bring you real-time analysis that mainstream media refuses to connect. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see the truth. And trust me, what I am about to reveal could save your portfolio. In this 30-minute deep dive, we will cover the war context and initial market shock, price comparisons before and during the conflict, day-by-day breakdown of what happened in March, key factors driving these wild swings, expert forecasts from JP Morgan, Bank of America, and more, and my top takeaways for investors like you. Let us dive in. First, let me set the stage because the speed of these events is staggering. On February 28, 2026, President Donald J. Trump authorized Operation Epic Fury. This was a precise, overwhelming military campaign to eliminate what the administration called the imminent nuclear threat posed by the Iranian regime. U.S. and Israeli strikes hammered over 2,000 targets inside Iran, nuclear facilities, air defenses, missile sites, Navy bases. The Iranian Red Crescent reports over 555 dead. And then on March 1st, the unthinkable happened. Ayatollah Ali Khamenei, Iran's supreme leader, was killed in the strikes. Let that sink in. The leader of Iran, killed by U.S. and Israeli forces. This is not a limited strike. This is regime decapitation. Iran responded immediately. Retaliatory missile strikes, threats to close the Strait of Hormuz, attacks on U.S. bases and embassies throughout the region. On March 4th, a U.S. submarine sank an Iranian naval vessel. The conflict is escalating, not de-escalating. Now here is why this matters for your money. The Strait of Hormuz is the most important choke point in global energy. 20% of the world's oil passes through that narrow waterway. When it closes, or even when there is fear of closure, everything changes. Oil prices jumped 5 to 8% daily. Brent crude spiked over 13% toward $82 per barrel. Inflation fears came roaring back, and central banks are now trapped between fighting inflation and avoiding recession. This triggered instant safe haven buying. Gold and silver prices exploded on day one, but then the volatility hit. Dollar strength, rising treasury yields, recession fears. Silver, with its dual role as both precious metal and industrial commodity, got hammered harder than anyone expected. Remember the Gulf War? Gold gained about 7.5% in the 6 months after. Russia-Ukraine? Similar pattern. But this conflict is different. This is direct U.S. military action against a major oil-producing nation. The implications are far greater. Now let me show you the numbers because this is where it gets truly shocking. Pre-war, on February 27th, gold was trading at $5,100 to $5,230 per ounce. Silver was at $85 to $90. Everything looked relatively calm. Then the strikes hit on February 28th. By March 1st and 2nd, gold peaked at $5,115 to $5,119 per ounce. That is a 6 to 12% surge in less than 48 hours. Silver hit $96 to $97.30, up 7 to 8% from pre-war levels. But here's where it gets painful. Fast forward to today, March 5th, early trading. Gold is at $5,050 to $5,150. That is down 1 to 3% from pre-war levels after that massive rally and subsequent 7% correction. Silver? It is worse, much worse. Silver is at $80 to $86, down 5 to 10% overall. And that brutal 19% single-session plunge, that wiped out months of gains for many investors in a matter of hours. Let me put this in perspective with a side-by-side comparison. Gold pre-war, $5,100 to $5,230. Gold peak, $5,215 to $5,219. Gold today, $5,050 to $5,150. Net change down 1 to 3% after the round trip. Silver pre-war, $85 to $90. Silver peak, $96 to $97.30. Silver today, $80 to $86. Net change down 5 to 10% with a devastating 19% single-day crash. What is driving this divergence? Gold is more stable as a pure safe haven hedge. It has no industrial demand component to worry about. When missiles fly, gold benefits. Period. Silver is different. Silver has dual identity. 59% of silver demand comes from industrial applications, solar panels, electric vehicles, electronics, AI data centers. When war triggers recession fears, industrial demand collapses, and silver gets crushed from both sides. If you bought at the peak, you are down now. But is this a dip to buy? We will cover expert predictions later. Keep watching. Now let me break this down day by day because every session tells a different story. March 1st, 2026. Gold closed up 2.3% at 5,278. Silver gained 1.4% to 95. The trigger was the confirmation of Khamenei's death and the initial strikes on Tehran. Safe haven flows dominated. Panic buying pushed both metals higher. March 2nd, 2026. This was the day of extremes. Gold peaked at $5,419, up 3% from the previous close. Silver spiked to $96.40, up 7 to 8%. But here is what happened next. Iran launched retaliatory strikes. Threats to close the Strait of Hormuz intensified. Markets initially gap-up opened on fear, but then silver crashed 7% intraday. Both metals closed well off their highs. The whipsaw had begun. March 3rd, 2026. Correction day. Gold fell 1.4% to $5,252. Silver tanked 6.5 to 11% to $80 to $83. What drove this? The US dollar rallied hard. Treasury yields spiked on inflation fears from oil. Risk-off sentiment hit everything, including precious metals. Silver got destroyed. The industrial demand fears combined with a stronger dollar created a perfect storm of selling pressure. March 4th, 2026. Rebound day. Gold gained 1.25% to $5,278. Silver recovered 2.59% to $95.71. The catalyst? A U.S. submarine sank an Iranian naval vessel, but paradoxically, markets rotated out of stocks and crypto back into metals. Investors realized the conflict was not ending quickly. The war premium started rebuilding. March 5th, 2026. Today. Gold is up 1.4% to $5,195. Silver is gaining 3.3% to $86. No de-escalation in sight. Strait of Hormuz risks continue. The volatility is far from over. What does this timeline tell us? Gold is acting like a traditional safe haven. It spikes on fear, corrects, then stabilizes at elevated levels. Silver is acting like a leveraged bet on chaos. It spikes harder, crashes harder, and recovers faster. If you have the stomach for volatility, silver offers bigger upside, but the downside can destroy you. Now let me explain why these wild moves are happening because understanding the drivers is essential for positioning. Factor 1. Safe haven demand. Gold is up 19% year to date. Silver is up 16% even after the crash. The war premium is real. If this conflict ends quickly, the premium fades. If it drags on, we see new all-time highs. Historical data shows gold averages 8.98% gains over 12 months following major conflicts. This is not speculation, this is pattern. Factor 2. Inflation and oil surging $10 to $20 per barrel changes everything. Higher oil means higher inflation. Higher inflation means the Federal Reserve cannot cut rates. Delayed rate cuts are generally good for gold long term, but bad for silver's industrial demand. Brent crude jumped 13% toward $82. This is stoking inflation fears globally. Factor 3. Dollar strength and treasury yields. The dollar index gained 0.22 to 0.65% during the crisis. Higher yields on U.S. treasuries hurt non-yielding assets like gold and silver. This created the paradox. War breaks out, safe haven demand surges, but dollar strength and higher yields create selling pressure. The result is extreme volatility. Factor 4. Broader market ripples. The S&P 500 fell 0.9%. Bitcoin dropped to $66,700. Defense stocks surged. Crypto whales moved $8.8 billion in a single day. Volatility is everywhere. When markets crash, margin calls hit. Investors sell whatever they can to raise cash. Sometimes that includes gold and silver. Factor 5. Supply disruptions. China controls 70% of global silver refining. They have restricted exports, classifying silver as a strategic material. Central banks are hoarding gold at record levels. The supply side is tightening while demand is spiking. This is structurally bullish even if short-term volatility is brutal. And here is the factor nobody is discussing. Europe's natural gas futures are surging. Energy crisis fears are spreading beyond the Middle East. This is not a regional conflict. This is global finance on edge. Now let me show you what the major institutions are projecting, because this is where you should pay close attention. Base case scenario: limited war. If the conflict remains contained and ends within weeks, gold stabilizes at $5,300 to $5,500 by mid-March. By year-end 2026, J.P. Morgan and Bank of America project gold at $6,000 to $6,300. Silver averages $85 to $91 in this scenario, elevated but not explosive. Bull case scenario: prolonged conflict. If the war drags on, if the Strait of Hormuz remains disrupted, if oil continues spiking, the projections get much more aggressive. Gold to $5,500 to $6,000 in the short term. Longer term, $8,000 to $10,000 is on the table. Silver, $100 to $200 becomes realistic. Some analysts project $309 based on gold-silver ratio compression to 1980 levels. Bank of America's Michael Widmer has issued one of the most extraordinary precious metals forecasts in history. He projects silver could reach between $135 and $309 per ounce in 2026, based on historical ratio analysis. Bear case scenario: rapid de-escalation. If peace breaks out tomorrow, if the Strait of Hormuz reopens, if oil crashes back down, we could see sharp corrections. Gold drops to $5,000 or below. Silver could fall to $49 to $79 if recession fears dominate. But here is what the experts are actually saying. TD Securities notes that gold benefits from geopolitical instability, and this benefit persists even after conflicts end. Saxo Bank warns that silver's spikes could drift if oil calms, but structural deficits provide a floor. J.P. Morgan analysts flagged a 5 to 10% risk premium jump even before the latest moves and still see $6,300 or higher longer term. My analysis? Bullish long term. History shows precious metals gain after crises. The question is whether you can survive the volatility to get there. Now let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. If you are holding physical gold and silver, do not panic. The volatility is real, but the fundamental case remains intact. Gold has no counterparty risk. It cannot be devalued by government decree. It maintains purchasing power across centuries. When missiles fly and nations clash, these characteristics become invaluable. Silver is more volatile but offers greater upside. If you have the stomach for 19% single-day moves, the potential rewards are significant. If you are looking to buy, volatility creates opportunity. The sharp corrections are potential entry points for long-term investors. The key insight from institutional analysts is that pullbacks are buying opportunities. The structural bull case, de-dollarization, central bank buying, supply deficits, these factors remain intact regardless of short-term war premium fluctuations. If you are trading short-term, be careful. Silver's intraday swings of $10 or more can wipe out leveraged positions instantly. Gold's $200 moves per session are not normal. This is not an environment for casual traders. This is an environment where professionals get humbled. The bigger picture. Financial advisors commonly recommend 5 to 15% allocation to precious metals, but the current conflict has prompted many strategists to advocate for higher allocations, particularly for investors concerned about systemic risks, currency debasement, and the potential for broader Middle East escalation. The war premium may fade if peace breaks out, but the structural case for precious metals, the debt crisis, the dollar weakness, the central bank buying, none of that changes. Let me leave you with this. In 5 days, we witnessed Operation Epic Fury launch, Ayatollah Khamenei killed, Iran retaliate with missiles. The Strait of Hormuz disrupted, oil spike 13%, gold hit 5,419, silver hit 97 barrel. Then silver crashed 19% in a single session. Gold corrected 7%. Global markets shed $2 to $3 trillion in 48 hours. This is the most significant geopolitical event since Russia invaded Ukraine. And for precious metals investors, it changes everything. Short-term volatility is extreme. Buy the dips if you believe escalation continues. Long-term gold and silver look structurally strong regardless of how this war resolves. The war premium is building. The structural drivers remain intact. Central banks are buying over 1,000 tons of gold annually. Silver deficits are entering their 6th consecutive year. China has restricted exports. Supply is tightening. History shows gains after crisis. The 1970s oil shock sent gold from $35 to $850. The Gulf War triggered sustained precious metals rallies. Russia-Ukraine added 7.5% to gold in 6 months. This conflict is bigger. The implications are deeper. And we are only in week 1. The question is not whether precious metals will respond to this crisis. They already have. The question is whether you are positioned for what comes next. Drop a comment telling me, gold or silver, which are you buying? I read every single comment. Subscribe if you have not already. Hit that notification bell because this war is evolving daily, and we will update you as the situation develops. If this helped you understand what is happening, smash that like button. Share this with someone who needs to see it. Thanks for watching AG Profit Hub. The real story is never on the surface. I will see you in the next one. Peace.